Hello and welcome to the Laundromat Ownership Podcast. I'm your host, Ian Gollahon. Me and my business partner, Brian Henderson, own Liberty Laundry in Tulsa, Oklahoma. And we also own the original point-of-sale system for laundromats, Wash, Dry, Fold POS, which is a software company. Today, I want to talk about sole proprietorships, LLCs, LLCs filing as S-Corps, and incorporations or corporations filing as C-Corps. I've actually owned all of these businesses in all of these different kind of states of my career, or phases of my career, I guess. And none of this is legal or tax advice, but hopefully I can tell you a few of the things that I've learned, and some of which I've just learned recently that I kind of wish I had known years ago. So before we get too deep into the things that are super applicable for every laundromat owner, I do want to talk about sole proprietorships just real quick, because actually the average person that listens to this podcast, and just the average American, is going to be by far most likely to open a sole proprietorship. And what is that really? Well, if you're doing any business that is not via an employer, and so you are technically then self-employed, so you're doing the business, let's say you're buying something at the store and then selling it on the corner of the street, lemonade stand style, right? That is technically a sole proprietorship. The IRS wants you to claim that income, and they want you to claim it as a sole proprietorship if you have not set up any other kind of business structure. And so it is a form of business, and the IRS recognizes it as a common business entity, but it's kind of almost the lack of a business entity too, because anything you do with revenue needs to be claimed and needs to be filed with the IRS. And if you don't do anything else, then it's a sole proprietorship. And so whether you've claimed it or not, or whether you've ever started a business, you probably still started a sole proprietorship, or you might one day. Filing an LLC is what you do when you have assets to protect, and it's what you do when you don't want to be sued personally for a slip and fall. Sole proprietorship, most common, most underrated. I'm sure I've had 4 or 5 over my lifetime. I used to play music, as you looking on YouTube might see that little record way up there. For the bird photography, I do bird photography. I spend money on cameras and that kind of stuff. And so those are little sole proprietorships. Now, I've never had a bird sue me. I'm not worried about a bird suing me. And so they're really, even though I do have assets to protect, there's no reason to form an LLC around that entity, because essentially what that entity does is buy cameras, take pictures of birds, and then I could sell prints online, that kind of thing. So that's an example of an entity that an LLC would probably be overkill for, and that a sole proprietorship would be, you don't really have to do anything to start a sole proprietorship except for track your receipts and do some real basic accounting, and then basically file it in your tax return. And you're even required to do that if you have any kind of income. So if you did sell some prints, for example, you need to be able to report that income. I'm just going to skip over partnerships real quick, because a multi-member LLC is what you're going to do if you have another business partner in the laundromat space. There is zero reason or zero chance that you would want to do a general partnership, which is like a non-LLC partnership for a laundromat. That would be psychotic. So, and I've never, ever run across, I've talked to 3,000 laundromat owners. I've ran to 3 or 4 sole proprietorships. Everyone else was an LLC or a corporation. I've never run into a partnership. That would be crazy. So there's no reason to even talk about that. But I'm going to get on to LLC, which is by far the most common form of entity that owns a laundromat. And you do want to have this created before you actually close on the deal, because the LLC is the structure that is going to own the lease. If you have a slip and fall, if somehow you lose your shirt on this, you've only lost what you've invested in the company. And so an LLC at least helps you create a vehicle that is separate from yourself, that is registered and has its own limit of liability as an operational structure that is separate from you, the person, right? Because you, the person, may have income or assets that you want to protect, and you want to keep that separate from the laundromat. That's why you spend the $200 and you get an LLC at the local state department. It's not hard. It's not complicated. You don't need to hire anyone to do it. You can do it in an hour. If you want to hire someone, fine. It's not hard though. So that is the basic idea for the LLC. And I think most of the listeners probably to this podcast, if you own a laundromat, you already have an LLC. So what about an S-Corp? Why would you file as an S-Corp? Now, people get really confused about this. You might say, do you have an LLC or an incorporation? And they would say, well, it's an S-Corp. That's kind of like saying, do you want chicken or steak for dinner? And you say, I want pudding for dessert. Okay, well, fine, but that's not what I asked you, because an LLC can file as an S-Corp and an incorporation can also file as an S-Corp. So an S-Corp is a tax filing status. An LLC and a corporation, that is a business entity. So the IRS says the most common ways to file a business is a sole proprietorship, a partnership, an LLC, or corporation. S-Corp is not listed in there because that's not a business entity, it's a tax filing status. So when you are an LLC, why would you file as an S-Corp? This is so complicated and hard to understand. So if you've never fully grasped it, I do not judge you one bit. And in fact, I had to own an S-Corp for several years before I really got my head around it and didn't have to think about it every time I thought about it. So let's say you do, and the cutoff point, people say 60,000. I see ads that say if you're doing 60,000 or more net profit, then get a file as an S-Corp and you can save all this money. I think that is marketing. I think you need at least $80,000 worth of profit, probably 100,000. And if it's a multi-person LLC, it may need even more. So let's say it's a one-person LLC, one-member LLC, and you're doing $100,000 in net profit. I'm not talking about gross profit. I'm not talking about, before all the bills. I'm talking about you are paying yourself at the end of that year $100,000. Great, wonderful. People that don't own laundromats or that have never owned a small business don't know the terrible little secret here that you're going to pay normal income tax on that $100,000, just like you would if you got it from a company, right? So let's call it 30%, 25%, something like that. And then you pay an extra 15%. Why? Because you're self-employed. If that doesn't sound fair, the IRS doesn't care what you think sounds fair. That's just the way it is. You're paying the income tax that you would normally pay, and then you're paying what's called a self-employed tax, and that's another 15%. If that sounds crazy, I don't know what to tell you. That's just, don't forget you pay sales tax every time you buy something, and there's all kinds of other taxes that you're paying for too, like when you go to the doctor or when you renew your tag on your car. That's just life. I can't do anything about that. However, let's say you are a single member LLC and you're making $100,000 net income. You could argue, or you could structure it. You could say, I'm going to file as an S-Corp. You have to then do payroll. You have to do these quarterly payroll payments through a company. I've heard some people do it on their own, but it's a lot of work. It's easier to just hire a payroll company to do it for you. And basically you have to withhold from each paycheck. And you essentially have to literally hire yourself as an employee. So now not only are you the owner, but you are also an employee of that LLC. And here's where it gets confusing. People would say, okay, as an employee, I've employed myself as an owner. So let's say my salary is going to be $40,000, because that would be the salary of a laundromat manager, $40,000 a year. And remember, there's $100,000 net profit that you're paying yourself every year as an LLC, single member LLC, $100,000 net profit. Now you're saying, I'm going to be an S-Corp and I'm going to pay myself I'm still going to pay myself that $100,000, but I'm going to pay myself $40,000 per year as an employee. Well, on that $40,000, you still pay your income tax and you still pay your self-employment tax. So you got to pay that extra 15% still. But on the $40,000 that is your salary, the $60,000 that is essentially at this point a distribution is exempt from the self-employment tax. So you could see, let's say it's a large structure that does $1 million plus in net profit. You could see how paying yourself $40,000, $50,000, $60,000, whatever it is that makes sense for let's say you're a laundromat manager. Well, then you're only paying that self-employment tax and the regular income tax. So you're getting double taxed on that salary. But then let's say you had another $900,000 that you were going to distribute to yourself. That is now a distribution that the LLC paid you, and that is exempt from the self-employment tax. And so 15% of $900,000 is a lot of money, right? It's $100,000 plus. So you would save an enormous amount per year. And we figured this out a little bit later than probably we should have, but we eventually became S-Corps both as a software company and as a laundromat. So it is the most tax efficient vehicle if you are going to pay yourself a lot of money over a long period of time as an owner. And that is the mission of not every laundromat owner, but of most laundromat owners, is you buy it and it just becomes a cash cow that you pay yourself net profit on every year. And the most tax efficient vehicle for that by far is an LLC filing it as an S-Corp. If you were an LLC filing as a C-Corp, I can't think of a single advantage of that for a laundromat. If you're going to flip that laundromat in 5 years or less, you should probably consider being a corporation so that you can sell with lower tax liability at the end of it under the QSBS laws. If you don't know when you're going to sell, or if you're going to hold it for a very long time, which is more common for laundromats, especially since laundromats typically don't sell at high valuations of multiples. I've got a whole other series on that. I'm not going to get into that, but they're not typically very high growth or very high multiple type of businesses. So that's why it's so uncommon to see laundromats as incorporated businesses or C-Corps. I have seen it over the years, and it typically is from distributors who are buying a laundromat. They know they're going to hold it for 5 years as like their showroom laundry piece or whatever, and then they're going to try and sell it to a public company, not as an asset sale, but as actual stock as a corporation. So C corporations, or rather corporations filing as C Corps, when you're filing with that tax structure, you are getting taxed on a corporate tax level. So every amount of net revenue that corporation has, that gets taxed once. And then you have to pay taxes again on those dividends that come in just under your normal income tax. So you get taxed at two levels versus with an S-Corp. Remember, an LLC filing as an S-Corp, they get taxed more on what the salary is. Remember, we talked about that $40,000 or maybe it's $60,000, depends on your area. That salary that you're paying yourself, you get taxed on that one twice. You've got that 15% self-employment. And then the rest of those distributions, you really only get taxed on once because you take them all out and you just get that standard income tax. That's just part of your standard income. The big takeaway from this is, if you're going to own a laundromat for a very long time and you're going to take a lot of cash out of it for a very long time, and that is the main value proposition of that laundromat, is to run it in a cash efficient way and then pay yourself with the cash, then an LLC filing as an S-Corp is the most tax efficient vehicle once you pass a certain amount of profit. I would say 100,000. If you're under that 100,000, just file as an LLC. I'll kind of review them all again. I think the sole proprietorship, probably the most common. Stay there until you really have a good reason to go to LLC. Then once you hit LLC, Stay there until you're doing $100,000 or more of profit per member of the LLC. And you might talk to an attorney about that or look at a calculator, but those are rough numbers. And then once you do that, once you have that much net profit, move to an S-Corp. These are kind of different seasons of a business. And some businesses won't ever make it to LLC. They'll just stay as sole proprietors. Some LLCs will never have more than $100,000 in net profit, and they'll never need to go to S-Corps. Some S-Corps will never be in a place where they're going to sell for some significant multiple, and so that they wouldn't need to necessarily convert to a C-Corp or an incorporation and then do that QSBS thing. And so that's kind of how I would look at it, as a evolution of a brand or of a business over time. And broadly, sole proprietorship, you don't have to do anything to have one of those. LLCs, like $200 with your state. I mean, I think the prices vary based on which state you are in, but it's very easy and simple to found and maintain. It protects your personal assets. S-Corp is the same thing. You still get all the protection, but then you actually pay reduced taxes when you self-employ yourself, and then take the rest out as distributions. And then the incorporated is really only beneficial if you have outside investors, which is very rare for a laundromat, but if you have a bunch of outside investors, so if you take venture capital or any kind of outside capital, that's almost always a C-Corp. But if you know you're going to sell at some point and it's not just going to stay in the family forever, that's when you might consider going to a C-Corp, and then you're actually selling the shares of the business, and it's not an asset sale. In that situation, it's actually a stock sale. The assets are tied to the stock, and then the stock sale is what you get the preferential tax treatment on. I hope this was helpful to someone out there. We've got more great episodes with more great content coming soon.